I research retirement strategy for a living, and the risk I'm about to describe is the one that surprises people the most, not because it's obscure, but because it hides in plain sight. Imagine you're 58, you've worked hard, you've managed to save $400,000. The market drops 30% in your first year of retirement. You're still withdrawing to pay your bills, and suddenly your plan, the one that looked solid on paper, starts to unravel fast. Here's why that scenario is more common than most people realize. According to the Federal Reserve's 2022 Survey of Consumer Finances, the median retirement savings for Americans aged 55 to 64 is just $185,000. That means millions of people are retiring with relatively modest cushions. A badly timed market downturn can permanently damage those portfolios. By the end of this video, you'll understand exactly what sequence of returns risk is, why it matters more than average returns, and what researchers say can reduce its impact, no matter where you're starting from. Chapter 1. What sequence of returns risk actually means. Let's start with a simple truth. Two retirees can earn the identical average annual return over 30 years and end up in completely different financial situations. The difference is timing. Sequence of returns risk is the danger that poor investment returns early in retirement, combined with ongoing withdrawals, will deplete your portfolio faster than any average projection would suggest. Here's why. When you're still working and contributing to your accounts, a market crash actually helps you. You're buying shares at lower prices, time is on your side. But once you flip the switch to withdrawals, the math reverses. Now, you're selling shares to pay for groceries, utilities, and health care. You're selling at low prices, and those sold shares can never recover for you because they're gone. This isn't a theory. Vanguard's research team has modeled this extensively. Their work shows that the sequence of returns in the first 10 years of retirement has a disproportionate impact on whether a portfolio survives a 30-year withdrawal period. Two identical average returns, say 6% annualized, produce dramatically different outcomes depending on whether the bad years come first or last. Your specific exposure to this risk depends on your withdrawal rate, your asset mix, and how flexible your spending can be. Those factors vary a lot from person to person. Chapter 2. Why the first decade is the danger zone, building on what we just covered. The early years of retirement are when your portfolio is most vulnerable, and that window matters enormously. Financial researchers refer to this as the retirement red zone, roughly the 5 years before and the 5 years after you retire. This is when a major market loss does the most permanent damage. Here's a concrete way to think about it. If you retire with $500,000 and withdraw $25,000 per year, that's a 5% withdrawal rate, and the market drops 35% in year one, your portfolio isn't starting from $500,000 anymore. It's starting from roughly $300,000 minus your withdrawal. Now, your same $25,000 withdrawal represents a much higher percentage of what remains. The math gets harder every year you continue withdrawing at that rate. According to research published by the Society of Actuaries, a 65-year-old woman in the United States has a roughly 50% chance of living to age 88. A married couple, both age 65, has about a 50% chance that at least one spouse will reach age 92. That means your retirement could last 25 to 30 years. A bad sequence in year one echoes for decades. This risk is more acute if you're a late starter. With a smaller portfolio, there's less margin. Your asset allocation choices matter more. And the temptation to take on more equity risk to catch up actually increases your sequence of returns exposure. That's the difficult irony. Chapter 3. The Cash Buffer Strategy. So what do researchers and planners say can actually help? One of the most discussed approaches is the cash buffer, sometimes called a cash reserve or liquidity bucket. The core idea is straightforward. You keep 1 to 2 years of living expenses in cash or very short-term stable instruments, money market funds, short-term CDs, or treasury bills. When the market drops, you draw from that cash reserve instead of selling equities at depressed prices. You give your invested portfolio time to recover. This isn't about predicting market crashes. It's about having a buffer so you don't have to sell at the worst time. The IRS has no rules restricting how you structure this kind of reserve. It can sit in a regular taxable account, a Roth IRA, or alongside your other assets. How much buffer makes sense depends on your fixed expenses, your other income sources like Social Security or a pension, and your personal comfort with volatility. Research from Morningstar's retirement team has found that retirees with even 1 year of liquid reserves show measurably lower rates of premature portfolio depletion. The psychological benefit matters too. Retirees who know they don't have to sell stocks in a downturn are less likely to make panic-driven decisions, which research consistently shows are a major driver of poor retirement outcomes. This strategy isn't free. Cash earns less than equities over time. There's a trade-off between reducing sequence risk and limiting long-term growth. That trade-off looks different depending on your total savings, your spending needs, and how long your runway is. Chapter 4. Asset Allocation and the Bucket Approach. The cash buffer is one layer. A broader version of that thinking is what planners often call the bucket strategy, and it's worth understanding how it works. The bucket approach divides your retirement savings into 3 conceptual pools. Bucket 1 is cash and stable assets, the short-term reserve we just discussed. Bucket 2 holds moderate risk assets, bonds, dividend stocks, balanced funds. This is your medium-term income source designed to be refilled as Bucket 1 is drawn down. Bucket 3 holds growth-oriented equities. This is your long-term engine. You don't touch it for at least 5 to 10 years. The logic is simple. You never have to sell your growth assets during a downturn. They can recover. Your stable buckets fund your spending in the meantime. According to Fidelity Investments' retirement research guidelines, a commonly cited starting point for asset allocation at age 65 is roughly 50% stocks and 50% bonds and cash. Though Fidelity is explicit that the right mix depends on your income needs, risk tolerance, and other sources of guaranteed income. There is no universal formula here. Someone with a pension and Social Security covering most of their expenses can afford to hold more equities in their growth bucket. Someone whose portfolio is their only income source may need a more conservative posture. The bucket strategy does require active maintenance. You have to refill Bucket 1 periodically. You need a plan for which assets you sell and when. It's not a set it and forget it structure. Chapter 5. Social Security Timing as a Sequence Shield. Here's a strategy that directly addresses sequence of returns risk, and it's one that many people overlook. Social Security timing. Every year you delay claiming Social Security past your full retirement age, up to age 70, your benefit increases by approximately 8%. That's according to the Social Security Administration's own benefit calculation rules. At full retirement age of 67 for most current workers, delaying to 70 adds roughly 24% to your monthly benefit, permanently. Adjusted for inflation via cost of living adjustments. Now here's the connection to sequence risk. Social Security is a guaranteed income stream. It doesn't fall when markets fall. If you delay claiming and use portfolio withdrawals only as a bridge, or use part-time work, a Roth IRA, or a cash buffer to fund those bridge years, you arrive at age 70 with a higher guaranteed floor of income. That means your portfolio has to do less heavy lifting every month, which means a market crash in year 1 of retirement damages you less. The Social Security Administration reports that as of 2023, the average monthly benefit for a retired worker was $199.07. But workers who delay to 70 often receive substantially more, in many cases over $3,000 per month, depending on their earnings record. That difference compounds over a long retirement. This strategy doesn't work for everyone. Your health, your need for immediate income, and your marital status all change the calculus. A single individual in poor health may reasonably claim early. A married couple with one high earner often benefits significantly from delaying the higher earner's benefit. These are the nuances worth exploring with a professional who can run your specific numbers. Disclaimer segment. Before we wrap up, an important note. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. What we've covered today is how sequence of returns risk works, the mechanics, the research, and the strategies that have been studied in academic and professional literature. Your situation is specific to you. A fiduciary advisor, someone legally required to act in your interest, can help you apply these concepts to your actual numbers. CTA. If this video was useful, subscribe to the channel. We post every week on retirement strategy for people who are starting later than they planned and who want honest, evidence-based information to work with. Next week, we're going to look at a question that connects directly to everything we talked about today: how to figure out what your actual Social Security benefit will be, and how to use the SSA's own tools to model different claiming scenarios. That video is coming soon, and it's one you'll want to watch before you make any claiming decisions. This video may contain affiliate links. I only recommend tools I use personally. Thanks for watching. Take your time with this information, and we'll see you in the next one.